everyone, and welcome to the fourth quarter of Quarterly Market Perspectives with Covenant Wealth Advisors. My name is Broderick Mullins, and I am the Portfolio Manager at Covenant Wealth Advisors. I'll be your host for the presentation. There is no sugarcoating the news. The U.S. and global markets took a hit in the first 3 months of 2022, offering investors an experience that they have not been accustomed to during the long bull market, a bit of red ink on their performance statements. We begin our discussion with a high-level look at a collection of major asset classes. As we can see from the illustration, both U.S. and developed international stock markets were down during the first quarter. Quarterly returns for U.S. and global bonds were also negative. Next, I'll draw your attention to the upper right-hand portion of the graphic. The U.S. dollar was up 2.4% for the quarter, and up 5.4% over the last 12 months. Now, let's take a little deeper look at what was driving the returns of stocks and bonds. We'll start by taking a look at how global markets performed for the quarter, and we'll isolate the performance between U.S. stocks and developed international stocks. The two charts here show the performance of different investment styles between the U.S. and international stocks. The bright blue bars represent the performance of different investment styles, and the dark blue bars represent the total market performance for the region. U.S. returns are measured with the Russell indexes, and international market returns are measured with the MSCI World X US Index Series, which represents global developed market performance excluding the U.S. As we can see from the dark blue line on the chart on the left, the U.S. market was down 5.3% in the first quarter, compared to down 5.2% for developed international markets in the chart on the right. In contrast to the fourth quarter of last year, global developed markets favored value stocks over growth stocks during the first quarter. However, markets were down overall, with international large value stocks posting the only positive performance for the quarter, as seen on the charts above. But no matter the recent trends, it is important to remember that we should not make longer-term projections based on short-term performance. Now we take a longer view to see how different investment styles have performed for standard periods ending March 31, 2022. Looking at annualized returns in the U.S., we can see a mix of strong returns, both negative and positive, for the 1 year, as the recent performance has been significantly influenced by factors such as the Russian invasion of Ukraine and its implications for global supply chains, and recent interest rate movements and the Fed's plans for future rate hikes to curb inflation. Large growth stocks had the best performance for the trailing 1 year period, returning 15% and beating the U.S. market by 3.1%. We also see that small value has underperformed most other styles at all investment horizons displayed on this chart. Consequently, we expect that portfolios that have a small value tilt, such as those we typically design for clients, will have underperformed portfolios that are market cap weighted or tilted to large growth stocks at these longer investment horizons. It is important to recognize, however, that despite the relative underperformance, small value has still returned a formidable 10.5% per year in the U.S. for the last 10 years. Turning to international markets, we see that large cap value stocks have led the pack over the 1 year period, albeit at lower return compared to the US. At the longer time horizons, we see small caps, particularly neutral and growth stocks, offering the highest returns over the 10-year period at 7.8% and 8.4% respectively. Relating the prior slides, we see that international markets have underperformed the US market at every time horizon, with the 3-year performance trailing by 9.6% per year and the 5 and 10-year performance trailing by 8.2 and 7.8% per year, respectively. Given the higher US return, we expect portfolios concentrated in US stocks to have outperformed globally diversified portfolios. However, as we'll see in the next slide, these relative performance numbers are not reason enough to abandon international stocks. Thus far, we've discussed quarterly performance on a relative and absolute basis. Now let's take a look at current stock market valuations and how they relate to future expectations of market performance. The charts on this slide show how expensive stocks are by measure of the price to earnings ratio, a very common metric used to value equities. The higher the ratio is, the more expensive the asset class is overall. Thought of another way, these values depict how expensive $1 of earnings is. For example, as we can see in the chart on the top left, the average dollar of earnings for the total US stock market costs roughly $21. Internationally, as we can see in the chart on the top right, earnings are cheaper at roughly $14 per dollar of earnings on average. The values represented here use historical fund and ETF data to establish the price ratios, and the average PE is reflected by the dotted line on the chart. These averages start in the first quarter of 2004 for US measures and in the fourth quarter of 2006 for international stocks. So the average is roughly 18 years in the US and 15 years internationally. In addition to identifying relatively cheap segments of equity markets, these ratios also help set the table of forming expectations about the future. Although we like to say our crystal ball is always cloudy, there tends to be an inverse relationship between current equity valuations and future performance. Generally, investors will bid up the price of certain stocks in expectation of higher future earnings. Therefore, as a particular group of stocks becomes more expensive, their expectations for future earnings growth are lessened because investors are less willing to pay an ever-growing premium for those expected earnings, especially when earnings can be bought elsewhere for less. Put more plainly, the more expensive stocks become in relation to their earnings, the lower their future performance expectations become. I'll emphasize that this is a long-term relationship, and as we've already seen on previous slides, there is a wide range of possible short-term outcomes. Here we have the same analysis, but isolating US equities, so we can see how valuations compare across different styles. Recalling the annualized performance slides, we know that large growth has had an exceptional 10-year period. We can see that the growth in prices has exceeded the growth in earnings, as the PE ratio has climbed to 29.1 to close the quarter. Small value, on the other hand, even with the rebound during the last 2 years, still has a PE ratio under 13 and under the average of the last 18 years. Although many investors may be interested in chasing the returns of large growth companies, we would point to these valuation charts as one reason to stay the course in a diversified portfolio tilted to small, relatively inexpensive companies. Next, we'll take a look at fixed income performance, the shape of the yield curve, and how the market is currently pricing inflation. The charts on the screen show the average performance of different bond maturities and the segments of the fixed income market that we commonly track. We typically prefer investing in bonds that are shorter maturity and higher quality compared to the broader market. In the chart on the left side, we see that bonds of all maturity ranges had negative performance, but markets favored the short to intermediate maturities relative to longer dated bonds. It's worth noting that the extreme price fluctuations that we tend to see in the 10 to 20-year bonds are why we like to keep maturities short to intermediate. The chart on the right shows the performance of different intermediate maturity credit quality bonds. we see again that all bonds in the credit qualities listed were down for the quarter, but inflation-protected bonds declined less as investors have continued to bid up prices to hedge their exposure to inflation. Treasury, municipal, and corporate bonds were down for the quarter, while investors showed a slight preference for U.S. Treasury debt. Next, we'll look at the Treasury yield curve and what it means for returns going forward. Here we plot the yield curve to show the current yields for Treasury bond investments at different maturities. The bright blue line represents current rates, the gold line represents rates at the end of 2021, and the dark blue line represents rates from 1 year ago. In short, the early part of the curve is steeper and is elevated overall compared to the end of last year and 1 year ago. Practically, this means that expected returns on fixed income are higher, but that Treasury returns would have been negative for the quarter and over the 1 year period. More notably, the majority of the yield pickup this quarter has been on the shorter side of the curve, so much so that the yield curve has begun to invert. When this happens, particularly between the 2-year and 10-year points on the curve, it is widely regarded as one of the precursors, but not as a guarantee to an impending recession. And while our crystal ball remains cloudy, as if to and when such a thing can occur, real interest rates likely have more room to run before the economy tips into recession. Finally, we plot the market's forecast of inflation by taking the difference in yields between U.S. Treasury bonds and TIPS at different maturity levels. Like the last chart, the bright blue line represents current inflation expectations. The gold line represents inflation expectations at the end of last year, and the dark blue line represents inflation expectations from 1 year ago. Consistent with what many are expecting and what we are hearing in the media, inflation expectations are higher compared to this time last year. It is important to remember that these levels of inflation are baked into prices today. The markets are pricing an average inflation rate of approximately 3.3% per year for the next 5 years. And the market collectively expects inflation to exceed the Fed's 2% target over the next 30 years. Not only are these expectations baked into bond prices, but they are also baked into equity prices. Making a bet on higher inflation would mean that we expect inflation to exceed the current forecast. The market already expects inflation to be higher than what was previously expected over the last year. So, what should you do when stock or bond markets decline in value? First, we always recommend that you review your financial plan with Covenant Wealth Advisors to help determine what, if anything, should be done to adjust course. Your plan should be reviewed at least once a year. If you don't have a plan, contact us. Secondly, look for opportunities to harvest losses in your portfolio. Tax loss harvesting, as it is called, is the process of selling holdings that may have temporarily lost money and repurchasing alternative holdings that help pursue similar risk and return characteristics. This may help capture losses on your tax return while still remaining invested in the market. Thirdly, consider investing additional cash on the side while markets are lower. While nobody can accurately predict when stock or bond markets have bottomed out, history tells us that purchasing shares at lower prices gives you a better chance of improving returns long term. And with that, we've reached the conclusion of the presentation. As always, I hope you learned something new, and if you're an existing client, thank you for your trust.